In the early 1700s, a Scottish financier named John Law rose to become the most powerful man in France. He reshaped the nation's monetary system, expanded paper money, and turned Paris into a frenzy of instant wealth. For a brief moment, his influence rivaled that of Europe's monarchs. Then confidence cracked. Prices collapsed. Within months, Law fled the country in disguise and spent the rest of his life drifting across Europe broke and largely forgotten. Around the same time in the Netherlands, seasoned merchants with fortunes built over decades lost everything chasing tulip contracts assets that felt safe right up until they weren't. These weren't amateurs. They were experienced traders who believed they understood money. They didn't fail because they lacked intelligence or access. They failed because they misread what level of wealth they were actually operating at and applied the wrong rules. That same mistake is still happening. People save, invest, and earn more than ever yet feel oddly stuck. Others rise quickly and fall just as fast. Not because money is unpredictable, but because it behaves differently after specific thresholds. I'm Alex. Today we'll walk through 3 specific net worth milestones that quietly change how money behaves, so you can see the mathematical and psychological turning points that separate lasting generational wealth from endless effort. Let's start with the assumption that traps almost everyone believing wealth grows in a straight line. Wealth operates in thresholds, not gradual progress. Money does not improve your life in a smooth, steady line. It moves in jumps, long stretches, where nothing seems to change, followed by sudden shifts, where everything feels different almost overnight. That's why 2 people with similar incomes can end up in completely different places after 10 or 20 years. Below certain levels, money is fragile. A car repair, a medical bill, or a short layoff forces decisions you don't want to make. You say yes to bad jobs, bad clients, bad timing because you have to. Every dollar has a job, and losing one feels dangerous. But then something subtle happens. Not a promotion, not a windfall. Just enough capital that mistakes stop being fatal. You can miss a month of income and still sleep. You can wait instead of rushing. You can turn down an offer that doesn't feel right. The rules quietly change. This is where most people get confused. They expect progress to feel linear, save a bit more, feel a bit better. Instead, they save for years and feel stuck, then suddenly feel lighter without a dramatic change in income. That disconnect makes people quit too early, right before the shift. The problem isn't effort, it's timing. Applying the same mindset at every level guarantees frustration. Money behaves one way when you're vulnerable, and a completely different way once you're buffered. Miss that distinction, and the math will never feel like it's working even when it is. That's the game most people don't realize they're playing. The first modern threshold, $100,000 invested. Below $100,000 investing feels like a scam. You're doing everything right, saving every month, staying consistent, yet your balance barely moves. You check the account after a year and think, that's it. 8% on $10,000 is $800. That doesn't change rent decisions. It doesn't change stress. It barely changes behavior. At $50,000, it's better, but still fragile. A rough market quarter can erase months of progress. You're still watching closely, still nervous, still tempted to stop and use the money for something tangible, because the payoff feels abstract. Then something shifts. At $100,000, the gains stop hiding. 8% is $8,000 a year, about $666 a month. Now you notice it. The account moves even when you don't touch it. A bad month hurts, but it doesn't scare you. A good month can add more than a paycheck bonus. Here's the part most people miss. The psychological change matters more than the math. When your investments start producing a noticeable slice of your income, work feels different. If you earn $70,000 and your portfolio adds $8,000, that's over 10% coming from capital, not effort. You don't quit your job, but you stop clinging to it. You negotiate differently, you wait more, and quietly the leverage shifts before anyone else can see it. The brutal reality of the early phase. Getting from $0 to $100,000 is the hardest part of building wealth, and it's hard in a way nobody prepares you for. It's slow, it's boring, and for a long time it feels pointless. You might be investing $500 a month, sacrificing weekends, skipping upgrades, saying no to things your friends say yes to, only to watch your account crawl forward. In the early years, almost all the progress comes from you, not your money. Put in $6,000 over a year and maybe see $200 or $300 of growth. That gap messes with your head. You start asking why you're working so hard for results that barely show up. That's when people rationalize quitting. They tell themselves they'll get serious later when income is higher or life is calmer. But later rarely comes. This phase filters people out not because they're irresponsible, but because the feedback loop is broken. Effort feels disconnected from reward. A single unexpected expense can wipe out months of visible progress. Market dips feel personal. Every decision feels heavy because the margin for error is thin. Here's the uncomfortable truth. Most people who never build wealth weren't reckless. They just didn't last long enough. They stopped during the phase where discipline matters more than intelligence, and patience matters more than optimization. The early phase isn't about returns, it's about endurance. And once it's over, the entire experience changes faster than you expect. Renaissance, Florence, the discovery of capital behavior. Florence in the 1400s wasn't a giant empire, about 60,000 people, no vast natural resources, no armies conquering neighbors. Yet this small city generated more wealth than kingdoms many times its size. The difference wasn't ambition. It was how capital was used once it reached a certain scale. Most merchants operated in survival mode. If a borrower walked in, they took the deal. Risky voyage, they funded it. Bad terms, they accepted them anyway. Turning down business meant falling behind, so every opportunity felt mandatory, even the dangerous ones. But once a bank reached enough capital, something subtle changed. Selectivity became possible. You could wait. You could let desperate deals go to competitors. You could say no to transactions that looked profitable on the surface, but carried hidden downside. That restraint, not aggression, created dominance. Here's the insight that mattered: money behaves differently once it can absorb failure. Below a certain level, a single bad decision can wipe you out. Above it, mistakes become dents instead of disasters. That changes how you think, how you negotiate, and how patient you can afford to be. This wasn't about clever contracts or secret techniques. It was about scale-creating optionality. Capital large enough to survive multiple bad years gave its owner time to choose quality over urgency. That lesson didn't stay in Renaissance Italy. It quietly carried forward, and it explains why two people can follow similar strategies today and still end up in completely different places. Threshold 1. Survival to stability. Below the first threshold, money is defensive. Every dollar is assigned a job before it even arrives. Rent, food, insurance, minimum payments. There's no slack. A delayed paycheck or a surprise expense doesn't feel inconvenient, it feels dangerous. That pressure leaks into every decision you make. This is why people in this stage say yes too quickly. Yes to overtime they don't want. Yes to clients they don't trust. Yes to loans with bad terms. Turning something down feels irresponsible because the margin is thin. You're not optimizing, you're surviving. Cross the threshold, and the tension eases not dramatically, but enough to matter. You still care about money, but you stop counting days until payday. You can cover a setback without scrambling. A bad month no longer threatens your identity or your future. That alone changes behavior. Here's the quiet advantage. Once survival is handled, patience becomes profitable. You don't need every opportunity, so you can wait for better ones. You can compare instead of grabbing. You can walk away from deals that look good, but feel wrong. This is where stability starts compounding, even before returns accelerate. The absence of panic improves judgment. Decisions get cleaner. Risks become calculated instead of emotional. Most people underestimate this phase because it doesn't look impressive from the outside. But this is where the foundation is poured. Miss it, and everything built later stays fragile no matter how high the numbers climb. Threshold 2. Walkaway power, $500,000. At around $500,000 invested, fear starts to disappear in ways people don't expect. Not excitement, not confidence, just the quiet absence of panic. Lose your job tomorrow and life doesn't collapse. Bills still get paid. Food still shows up. You have time, and time is leverage. This is the point where money stops being about growth and starts being about control. Using a conservative withdrawal rate, that portfolio can cover roughly $20,000 a year. That's not luxury. It's survival without begging. It's the ability to wait instead of rushing into the first bad option that appears. And that changes how you behave at work. You speak up more. You negotiate harder. You stop tolerating environments that drain you, not because you're reckless, but because consequences no longer feel terminal. Employers can sense this, even if they can't name it. People with options are treated differently. The math quietly tilts here too. At average market returns, a $500,000 portfolio can generate around $40,000 a year on its own. For many people, that's more than they save annually. Your money becomes your most reliable worker, showing up every day unpaid, unsupervised. But here's the trap. Some people reach this level and still think like they're broke. They panic during market drops. They sell at the worst time. They destroy what they've built because their identity didn't update with their balance. This threshold isn't just financial, it's psychological. And if you don't cross it mentally, the protection never fully turns on. Psychological failure at the second threshold. This is where a lot of people quietly lose the game after thinking they've won it. On paper, they're secure. The account balance looks right. The years of saving are done. But mentally, they're still acting like one bad month could ruin them. When markets drop, the numbers swing hard. A portfolio that once showed $500,000 suddenly reads $420,000 or $380,000. Nothing fundamental has changed, but the emotional hit feels real. For someone who hasn't updated their identity, that temporary decline triggers the same fear they felt years earlier when they actually were vulnerable. So they react, they sell, they move to cash, they wait for clarity. In doing so, they lock in losses that were never meant to be permanent. The money was supposed to be a fortress. Instead, it becomes a source of anxiety because it's being treated like emergency cash instead of long-term capital. What's ironic is that this stage requires less action, not more. The portfolio doesn't need protection from the market. It needs protection from its owner. The discipline here isn't about saving harder or optimizing returns. It's about restraint. Security only works if you believe it's real. If you still see yourself as fragile, you'll sabotage the very buffer you spent decades building. That's why this threshold isn't crossed by numbers alone. It's crossed when volatility stops feeling personal. And until that shift happens, the second milestone never delivers what it promises. Threshold 3, the inversion point, $2.5 million. At around $2.5 million invested, the math flips in a way that feels almost unfair. Using conservative assumptions that capital can generate roughly $150,000 a year, not from hustle, not from overtime, just from existing. For most people, that's more than their salary ever was. This is the inversion point where money becomes more productive than time. Below it, working harder makes sense. Extra hours mean extra income. Above it, trading time for money becomes inefficient. Your capital is doing more in a day than your labor can do in a week. That's why wealthy people behave so differently. They're not lazy, they're selective. Spending 60 hours to earn an extra $20,000 doesn't impress them because those same hours might cost more in missed opportunities, poor decisions, or neglected capital management. Think about it practically. A portfolio producing about $400 a day keeps working, whether you show up or not. Weekends, holidays, sick days, it doesn't care. If a job pays less per hour than your capital produces passively, continuing to grind starts to work against you. Here's the part that surprises people. This doesn't lead to reckless spending. It leads to restraint. Time becomes scarce. Decisions slow down. Risk is evaluated differently because the downside is no longer losing money, it's losing position. Cross this threshold and the question isn't how to earn more. It's how not to interfere with what's already working. Why salary alone rarely reaches the third threshold? For most people, income isn't the problem. Structure is. Even a very high salary runs into a mathematical ceiling. Save aggressively, invest consistently, earn solid market returns, and the timeline still stretches out further than most expect. Run the numbers honestly. If you're saving $50,000 a year, which already puts you in rare territory, and earning strong long-term returns, moving from $500,000 to $2.5 million can take close to 2 decades. That's 20 years of peak effort, discipline, and patience without interruption. Life rarely cooperates that long. This is why most people who cross the inversion point don't get there through wages alone. They own something, a business that scales, equity in a growing company, real estate that produces income and appreciation, a stake in something that grows faster than their time can. Traditional advice isn't wrong, it's just limited. Saving a fixed percentage maxing retirement accounts, staying diversified, that path is designed to create security, not inversion. It aims for stability, not dominance. And there's nothing shameful about stopping at security, but confusing the two creates frustration. People follow the rules perfectly, then wonder why they still feel capped. Here's the quiet distinction: salary builds safety. Ownership builds acceleration. One protects your downside, the other breaks ceilings. Until that shift happens, the third threshold remains visible but out of reach. Institutional incentives to keep thresholds hidden. If these thresholds were common knowledge, a lot of business models would quietly break. Banks don't profit from people who don't need loans. Credit card companies don't win when balances get paid off quickly. And employers don't benefit from workers who can afford to walk away. That's why the conversation stays focused on income, raises, promotions, side hustles. As long as you're watching your paycheck, you're not watching your net worth. Money flows through you, not toward you, and that keeps you dependent. Consumption fills the gap. New cars every few years, bigger homes the moment you qualify, subscriptions that quietly absorb every raise. None of this is accidental. Entire industries exist to capture extra income before it ever becomes invested capital. Even financial advice plays a role. Complex strategies, constant optimization, active management, all distractions. When the real bottleneck is simply reaching the first threshold. If you're buried in tactics, you're less likely to notice you're stuck. The most important part is psychological. Getting to $100,000 is slow and discouraging. If you can be convinced it's unrealistic, unfair, or not worth trying, you'll stop early. And once you stop, you don't become independent. You become a permanent customer. That's the quiet advantage of confusion. When people don't see the milestones, they never aim for them. They stay busy, stressed, and productive, just not for themselves. Understanding this doesn't make you cynical. It makes you precise. Strategic actions by wealth stage. What you do with money has to change as your situation changes. Using the same playbook at every level is how people stall or undo years of progress. Below $100,000, simplicity wins. The only real objective is accumulation. Fancy strategies don't matter. Asset allocation tweaks don't matter. What matters is getting money invested consistently and quickly. Cutting obvious expenses, increasing income where possible, and automating contributions beats every clever idea at this stage. Between $100,000 and $500,000, the game shifts. You've proven you can build. Now you protect. That means real emergency reserves, not just optimism. It means avoiding concentration too much company stock. One property, one sector. This is also where you quietly build flexibility. Ask yourself how long you could operate without income. If the answer is uncomfortable, that's the gap to close. Above $500,000, the focus moves again. Growth no longer comes from saving harder. It comes from ownership, equity, stakes that scale without your time attached. This is where people who keep chasing raises feel stuck, while others start accelerating with less visible effort. And above $2.5 million restraint becomes the skill. The danger isn't missing opportunities, it's forcing them. Protecting position matters more than chasing upside. Diversification, patience, and legacy thinking replace speed. Each stage rewards a different behavior. Miss that, and money feels harder the more you have. Match it, and progress starts to feel oddly calm. Key takeaways. Wealth doesn't reward effort evenly. It rewards alignment. The same behavior can feel disciplined at one stage and destructive at another. That's why so many people feel like they're doing everything right and still not moving forward. They're playing the wrong game for the level they're in. The first real shift isn't financial freedom, it's psychological relief. The moment money stops feeling fragile, decisions get cleaner. Fear fades, patience increases, and judgment improves. Not because you learned more, but because pressure loosened. The second shift isn't about earning more, it's about needing less. Walkaway power quietly changes how you're treated, how you negotiate, and what you tolerate. But it only works if your identity catches up to your balance. The final shift isn't luxury, it's inversion. When capital outproduces labor time becomes the scarce asset, the risk isn't missing out, it's interfering. The people who build lasting wealth aren't smarter or luckier. They adapt. They change strategy as the rules change. And once you see those rule changes, clearly progress, stops feeling chaotic, and starts feeling intentional. If this way of thinking feels unfamiliar, that's a good sign. It means you're starting to see the structure, not just the surface.